Hey everyone, just wanted to do our lesson today in regards to tax strategies for real estate. There's a lot of misconceptions out there about tax strategies for real estate, and a lot of people don't even know that there are strategies that exist. So I brought on one of the foremost experts in this week's lesson, Mr. Kyle Kadish of Advantage Wealth Solutions. Kyle, thanks for joining me here today.
No, Rob, I'm glad we've connected and looking forward to this conversation to help your clients understand what possibilities are out there.
Absolutely, absolutely. So with that being said, everyone that's listening has an interest in tax strategies around real estate. And I think the most basic, I wouldn't even call it a tax strategy, but the most basic, available tax advantage that people would have is just deferring their gains as they move up through properties. Property taxes being written off in certain circumstances, and expenses being able to be written off in certain circumstances of an investment property or whatnot. I think most of our listeners probably understand those basics of the tax code, but if you can just give a very brief overview of that for somebody that may be listening that's not aware of that or is a brand new real estate owner or real estate investor.
No, certainly. Just baseline to start, it's my belief that any tax policy is created to stimulate the economy. And for real estate owners, there are multiple parts of the tax code that allow them to let their money keep working where they won't be taxed immediately. The most common one that everyone uses is when they own their house, they can have a gain of $250,000 or $500,000 on free and clear just from selling that. For real estate investors, there are other tax codes and provisions within the tax code that allow more of their money to keep working, or ways the sale can be structured to defer that tax payment. All we're talking about is deferring the taxes. And nothing we do is about avoiding. We know that we'll have to at some point in time, but let's let our money keep working as long as we possibly can.
Okay. So, if you're just somebody buying your first home or whatnot, or maybe you own a home, then that will definitely apply to you, because I think that's been around a while. I don't really see that going anywhere. So that is something that's going to be available to you regardless. But what we really want to dive deep on, in this lesson today is going to be a little bit more advanced tax strategies. We're going to talk about a few things that you may have not heard of before, different ways that you can buy and sell real estate, either deferring or, just changing the type of taxes that are going to need to be paid to your advantage. Okay. And there's different ways to do that. So there's 3 strategies that we're going to focus on here today that I want to discuss with Kyle for all of our listeners and viewers. And those 3 strategies are going to be 1031 exchanges. You may have heard of that before because it's a hot topic right now, but you may not understand how they work. So Kyle's going to be breaking it all down for us. Then we're going to talk about purchasing real estate through an IRA, which is an amazing strategy that can be used. A lot of tax advantages to doing that. And last but not least is going to be using a deferred sales trust. And I think that's probably more on the advanced side, but there are other tax strategies that can be used without a doubt. There's a lot of other strategies that Kyle does teach and has access to, but to keep this short, sweet, and to the point, those are the 3 that we're going to be focusing on here today. And those are probably the 3 that will give you, the viewer and listener here, the most traction that you'll want to use in your circumstance. So with that being said, let's dive right in. Let's talk about 1031 exchanges. So in a nutshell, Kyle, if you can just tell our viewers and listeners here, what is a 1031 exchange?
Yeah, if you own investment real estate or any property that is used for investment, you can sell that property and use all of the proceeds to purchase another property used for investment without and deferring the tax liability from that sale. Lots of confusion as to what investment refers to, and it simply refers to the use of the property rather than the type. If you own a strip mall, you can sell that and purchase on the other side of the exchange maybe a multi-family property, 3 or 4 units, or even 10 units. You can sell industrial warehouse and purchase interests in a securitized vehicle that qualifies for a 1031 exchange. Again, it simply comes down to using as much of the proceeds to purchase other property for investment, and it does not need to be one property for one property, Rob. You can sell one and buy two. You can sell two and buy one. It really doesn't matter.
Okay. So if somebody's going to sell, let's say, a two-family property that they had rented out, and they're going to turn around and they're going to buy a single-family investment property, that would still qualify, correct?
It certainly would, as long as it is continued to be used for investment purposes.
Okay. So that makes sense. Can you give maybe an example of one that you've worked on that, I don't know, maybe it wasn't as clear cut? Because I think, from what you're saying, it makes sense. It sounds straightforward. But in what circumstances maybe is it not as straightforward, or you need to get a little bit more intricate?
Well, not necessarily intricate, but the ways some investors have used the strategy. Maybe there's someone here in the Northeast who owns property and investment property and is looking to retire down in a warmer climate in a few years, let's say Florida. So maybe they own the investment property in Connecticut or Massachusetts. They sell that property, that investment property today. Through an exchange, they purchase another investment property down in Florida, and they use it as an investment for a few years until they retire, and then that becomes their second house. They convert the use. That is allowed. There are certain guidelines that need to be met, but if it's used as an investment or when it's purchased, it can be converted. It often can be converted at a later date for personal use. There might be an individual who's structuring an estate plan, and maybe they have 3 children, but own a duplex as an investment property. Usually that doesn't end up very well because maybe one child wants to live in the property, one wants to own it, and one wants to sell it. How will they decide? Well, maybe through a 1031 exchange, they purchased 3 individual properties, one earmarked for each one of the children or each of the heirs. Maybe someone owns a property in Boston, and Boston has seen a great appreciation in price over the past decade. There's maybe not as much upside remaining in Boston. They can purchase a property in a different market that has greater upside. Or maybe they've owned that property the residential property for 27 and a half years and have fully depreciated it. So they cannot offset any more of that income that is income paid from that property. So they might conduct an exchange and buy a larger property. This is just one slide we often discuss as to why someone would sell through an exchange. There are plenty of other reasons and conversations, but certainly capital gains tax deferral is one. It's not the only reason for it. Maybe it's preservation of capital. The estate planning want to diversify their investment portfolio into other asset classes or property types or locations, or even increase that cash flow. I think it is important to note that anyone conducting a 1031 exchange can buy property anywhere within the United States. It is within the federal tax code. So as long as
so it sounds pretty flexible. I mean, overall, as long as you're going from the same property type, it's pretty flexible. Can you give maybe an example of a downside to doing a 1031 exchange, or a negative on why you wouldn't want to do a 1031 exchange? I mean, obviously, if you're trading in an investment property to buy a primary home, I can see that wouldn't work as a 1031 exchange. Or if you're selling your primary home to buy an investment property, maybe that wouldn't work. But can you talk about a scenario where there would be a negative connotation associated with this?
Certainly, Rob, and this is coming up more and more every day, the conversation of what's going to happen with tax rates in the future. A lot of individuals and media reports are saying tax rates are only going to go up. A lot of it could lie on the election 3 months from now, what the outcome is, but it could also just rely on the printing press that has been coming out of Washington and what will happen with the federal budget. So That is caution a lot of individuals provide. Now, there are two sides of the coin here. Yes, rates could go up in the future. So how about I sell, pay my taxes on a lower rate today rather than exchange and then have a higher rate in the future? The answer to that is you can continue to exchange throughout your life, and upon your death, the tax liability is erased. Your heirs receive the property as what's called a stepped up value. So if you sell a property today for $100,000 and purchase one for $100,000, and then 2 years from now it's worth $200,000, or a few years from now it's worth $200,000, and then sell that, buy another one. A few years later, maybe that's worth $400,000. Each time, your capital gains, your gains will be increasing. Well, your heirs might eventually receive that at the stepped up value, which means they would receive it at that $400,000 mark and not be liable for the deferred gains. So it will be free and clear for them. So it really is a massive wealth generation tool.
It seems like the scenario where if somebody is a real estate investor and they're not using something like this, they're missing the boat. I mean, this is one of the main tax strategies used by real estate investors. I know every big real estate investor I know uses 1031 exchanges all the time. They're just growing that value, growing that nut bigger and bigger. And, you know, like you said, taxes can be paid upon death or don't need to be paid upon death. So that's a huge advantage, you know, to using this. So I think if you're somebody watching or listening and you're either already a real estate investor or you're getting into real estate investment, this really needs to be the cornerstone of your tax strategy. Would you agree?
It is something that definitely needs to be considered. It has been around for nearly 100 years, so it's nothing new. Unfortunately, there's no hard concrete data as to how many exchanges happen every day or what price point they are, but as long as the property is used for investment, individuals are conducting 1031 exchanges. It is important to note the exchange needs to be in place before you sell the property. Okay. If you sell the property and the money goes right from the closing table to your bank account, it's taxable.
So this is going to be something that needs to be planned ahead for. You need to consult with your financial advisor, tax advisor, CPA. You know, those type of individuals will need to be involved in drawing the correct paperwork up, making sure that the transaction happens in the correct order, in the correct way, in order to actually do this the right way, so you don't end up getting hit at the end with a bunch of taxes that you thought you wouldn't have if it's done incorrectly.
Yeah, correct, Rob. And I think when it comes down to your financial advisor and tax preparer or accountant or tax advisor or lawyer, yes, they will help review if it is a suitable strategy for you. You need an independent party involved in the process called a qualified intermediary. Usually 30 days, 60 days out is plenty of time for a qualified intermediary to work with you in creating that exchange.
And is the qualified intermediary going to be somebody that is a financial advisor, or what type of person would be the intermediary?
Yeah, it depends on the state. It is only regulated in a few states. They do need to be licensed in Connecticut to act as a qualified intermediary. There are exemptions that do prevent them from registering with the state. It's an independent third person who you have not had a direct business relationship with. There are plenty of individuals who operate exclusively as a qualified intermediary. Your financial advisor, your accountant cannot be your qualified intermediary. Hopefully they can help direct you to one that they know. If not, there are a few I work with as well.
Yeah, so you'll want to consult with them to get that taken care of, to get that intermediary lined up, so to speak. Like Kyle said, 30 to 60 days before the closing of the transaction should be plenty of time. I would recommend, as soon as your property goes under contract, I would recommend that you get all these things in play. This isn't something you want to be dealing with at the 11th hour.
Yeah, and Rob, I would even say before you go under contract, simply because you don't want to have to go back and amend all the documents. You'll need a couple statements within the P&S.
Okay, that makes sense. All right, well, we've given you guys kind of that overview on 1031 exchanges, so I want to switch gears here now and move to our next strategy, which we're going to be talking about, which is purchasing real estate through an IRA. So I guess the question I've got for you is, purchasing through an IRA, is it different if you're buying an investment property versus if you're buying a owner-occupied single-family home? I know a lot of our listeners and viewers here, they're going to be looking at buying their first property or maybe their second property. They might have a bunch of money in an IRA that they've been accumulating from their job. So can you talk about the specifics on purchasing through an IRA, and then is there differences buying a single family or multifamily owner-occupied home versus an investment property?
Sure, and the owner-occupied or personal use will not work with proceeds from the IRA.
Okay, so this is only for investment properties.
Let me make one point clear. Individuals can take distributions from their IRAs, usually without penalty, if it is going for the purchase of their primary residence.
Okay, but the differentiation is that if you're going to be pulling money out of your IRA for purchasing a home, you're not purchasing it through your IRA. You're simply
Correct.
taking money that was in your IRA and taking a distribution out, like you said, penalty-free in most cases, to use as a down payment or towards closing on a new property. What we're focusing on here is purchasing it within the IRA without actually pulling the money out.
Yes, and this is something most people don't even know exists. And hate to say, there are many financial advisors that don't recognize this opportunity as well. Most individuals are thinking of an IRA, whether it's held at Schwab or Fidelity or Ameriprise, Vanguard, wherever it might be, of just owning stocks, bonds, mutual funds, and ETFs. But you can make almost any investment with your IRA. A few things need to happen is where the money, you cannot have constructive receipt of the money. It still must be held through a custodian. And there are a handful of custodians out there. Any Google search will provide you with a list of some that would focus on being able to purchase real estate or other investments through your IRA. When it comes down to it, there are two different ways to do it. One is having the IRA directly own the real estate. It might become a little more cumbersome with fees because you'd have to have more transactions from the IRA account, as well as it could be tough to qualify for that non-recourse financing in that position. The other way to do it is have the IRA invest in a single member LLC. Provide checkbook control to you as the managing member of the LLC to then go and purchase the property.
That sounds like it would be the best option based on what you're saying, is to use the IRA to invest in a single member LLC, which then you have control over. You can write the checks out of. It'll be a lot more simple from an accounting standpoint. It'll be less cumbersome from a fee standpoint, since the IRA custodian won't really be involved in the day-to-day doing it that way, correct?
Yes, I think that is what more individuals do when they are buying through an IRA.
So taking that a step further, if I'm going to buy a property through the IRA, an investment property, what is the tax advantage of doing that? I mean, we know there is a tax advantage, but what is the tax advantage?
Yeah, I think the biggest advantage is those, like any other IRA, the money will continue to grow on a tax-deferred basis until you take those distributions out. So it's a way to continue allowing for that money to work.
So you can just keep growing that money, buying another property, selling that all within that IRA, and it'll just keep growing without having to pay taxes until the end. Now, with the IRA strategy, is it like eliminated upon death, like the 1031, or is that going to be 1031 is going to be preferred over the IRA because of that specific?
Yeah, that's one item to consider, and it will vary on each individual's situation. That IRA will likely be inherited by the heir, and there will likely be requirements that they withdraw or deplete the funds within a certain timeline. So it might be tough at that point in time, but you can invest in that real estate today and continue to grow the wealth through the IRA. And then maybe as you amass the wealth, diversify out of the real estate. So it is not all completely tax-free. There is tax deferral on the asset growth. Depending on any financing that might happen on purchasing that property, there might be something called UBTI, or unrelated business taxable income, that the taxpayer may be subject to.
Okay. So like everything we talk about here, you're going to want to consult with your tax advisor, financial advisor, et cetera, to make sure, you know, which one of these strategies is going to work best for you, which is applicable to you, and, you know, which is going to give you the best bang for your buck as far as a strategy to defer taxes. So
certainly, let me add one other point to that, though. With the IRA, since everything is already tax deferred, when you sell a property that's held through that LLC in your IRA, you don't need to do a 1031 exchange because it's already tax deferred.
Okay, so it makes it a little bit easier to do that. Obviously, you don't need the third party.
So you may or may not need to. Let's put it that way, depending on how it's held within the IRA.
Okay.
So certainly consult with your accountant, your tax advisor, and financial planner.
Okay, excellent. So the last strategy that I want to talk through here, which most people have probably not even heard of, because I know it's a bit more advanced than these other two, is the Deferred Sales Trust. So can you give a brief overview of the Deferred Sales Trust and kind of talk about where and when this makes sense to use, and some of the pros and cons about why this is so attractive?
Yeah, and the Deferred Sales Trust is a trademarked name of a tested the installment provisions within the tax code. For over 25 years, I'm affiliated with a group that has, for over 25 years rather, been creating these deferred sales trusts. The idea is that you can take the proceeds from the sale, and rather than a typical installment sale, you can structure an installment between an independent third party. The independent third party would hold the proceeds, and you determine when you want to take receipt of those proceeds. That it creates a few interesting scenarios here. One, you now have a liquid portfolio. You can diversify greatly outside of real estate. But if you want to stay in real estate, one challenge a lot of 1031 buyers and sellers have is they're required to follow a very strict timeline from the Internal Revenue Code that says 45 days to identify and up to 180 days to purchase the replacement property. That means if you're selling a property today because you think the market is at a peak, you'll likely be buying another property at a peak within a 1031 exchange. The Deferred Sales Trust allows you to sit on the sidelines for a few years and have the trust use those assets to purchase that next property at any point you determine.
Okay. So basically the sales trust is a quote unquote like a legal entity that's being set up, or that has been set up in the past, in order to hold these properties or the proceeds from the property. Is that correct?
It is a unique entity established for each taxpayer whenever they are selling a highly appreciated asset. In addition to real estate, it works well for business owners. It works well for anyone who's owns collectibles, maybe that second residence or their second house on the Cape or other house down in Florida that doesn't have that primary residence provision we spoke about at the beginning. So there are many ways it could be utilized through the sale of highly appreciated assets. One of the benefits here as well is it's a way to aggregate properties or aggregate your portfolio to one simple location. So if you own 10 different multifamily units or buildings around Connecticut, as you sell each one, you could transfer each one to that trust. You've now aggregated all of your assets in one place.
Okay, now let me ask you this though. Does the Deferred Sales Trust need to own the property at the time of disposition, or how does the timeline work with all this? If I own a 2-family rental property, I've had it for a couple of years now, and I'm thinking about selling it in the next few months, where would this Deferred Sales Trust play in?
Sure. This is very similar to what we discussed with a 1031 exchange. 30 to 60 days out is enough time. You're going to be working with a broker or yourself to market and get that property under contract. And immediately before the sale, the asset is transferred to the trust.
Okay. So this, how long does it normally take to create one of these sales trusts? And what would you say on average the cost would be? Because if you're, I know for a lot of these, it's like if there's a very small amount of profit and we're talking about, minimal, it may not even be advantageous to use a deferred sales trust. So what would you say is kind of your benchmark bottom line of where this makes sense to use based on cost and timelines and whatnot?
Yeah, let's just say timeline, again, 30 to 60 days in advance of selling the property makes sense. For the cost, it's going to vary on every situation based on how much that gain would be, how much the deferred, the depreciation recapture is, and how much financing or debt might be held on a property that's being sold. In addition to that, look at the income level of the taxpayer and what state they are paying taxes in and they're a resident of. I usually like to see a plus or minus 200,000 on a gain or be subject to capital gains, a lower gain amount in a higher tax state, Massachusetts or Connecticut. Maybe your gain will be about 180,000 for it to be efficient.
Okay.
In a low tax state, Florida, maybe it's closer to a $250,000 gain. It all varies within the numbers. Certainly, the larger the asset, the more efficiency there is with the Deferred Sales Trust.
So from what you're saying, it really sounds like the Deferred Sales Trust is going to be, without a doubt, more applicable to people that have multiple properties, a higher net worth. Maybe they've had properties for longer, so they've got a bigger gain coming. It's not going to be for your maybe first-time real estate investors or property flippers that are holding a property for a short amount of time. Maybe they're only making $40,000, $50,000. It doesn't sound like that would be the best bet as far as on an individual level. Maybe if they had a lot of properties that they were going to make $30,000, $40,000, $50,000 on 5 different sales, then it might make sense to do this to recapture on a lot of them together, but not on an individual basis, correct?
That is very well said, yes. If you just own a single a single family that's used for investment, it's probably not going to make sense to look at the Deferred Sales Trust. 1031 exchange would likely be your better option.
Okay, so kind of just recapping here, I think that, what we've really been trying to do here is give the listeners and viewers the overview of the most common tax strategies that they can use. And I think we've done a good job about giving them that information. For a lot of these viewers and listeners, maybe you're just buying your first property or you just bought your first property, in which case, some of these may not even apply to you at all. But what you are going to be able to take advantage of is one of the main reasons why people love real estate in this country as an investment, is because you can defer like we said at the beginning of this, either $250,000, I believe that's for an individual, or $500,000 for a married couple on the gains of your residence. And what is the criteria for that? You have to have lived in the property for how long?
So as long as it's used as your primary residence, that would qualify. Usually a few different ways to demonstrate that if it is ever questioned. What usually happens, or the real question is, must have been your primary residence within 2 of the last 5 years.
Okay, that's what I was looking for. So somebody that just buys a property, lives in it for a year, and then sells it and makes $50,000 because the market went up or they did some work on it, that's not going to apply to them, correct?
Correct.
Okay, so yeah, this is, most people, if you've watched my other lessons videos, we don't really recommend buying a house if you're only going to keep it for 6 to 12 months. This is, housing, real estate is typically going to be a more long-term investment if you're not set up and strategized to do a short-term hold, a flip, that sort of thing, which we don't really condone that much on this channel and what we teach. So with that being said, if you're someone buying your first home or just bought it, then you want to live there. You want to keep that property for at least a couple of years so you can take advantage of this part of the tax code that's going to allow you to defer those gains onto the next. And of course, I know that a lot of things changed in the last few years in regards to the real estate, but for many people, you can still write off up to a certain amount of the property taxes. If you're an investor and you've got expenses like repairs and other things of that nature, you can write those off on your taxes against the income. So there's some great just standard tax advantages that are available. What we're doing here is taking this a step further. So, we can only go over so much in a 30 to 40 minute webinar, Zoom meeting, podcast type of situation. But with that said, if you're listening or watching this and you want to take this to the next level, you want to implement this, and this is something that resonates with you, then I would recommend getting in touch with a financial advisor, a tax planner, a tax advisor. Kyle is a great resource. I want everyone to take down Kyle's information so you can reach out to him. He can do an individualized consultation with you and tell you if any of these strategies work. There's other strategies he teaches that we haven't touched on here that may apply to you even better. And I know, Kyle, you work all over the country. You're not just working in New Hampshire or Massachusetts or Connecticut. So, don't feel afraid to reach out to Kyle directly if you'd like to explore some of this. And Kyle, please go ahead and give everyone how they can get in touch with you.
Yeah, the best way to connect with me is via phone, 877-866-1031. 877-866-1031.
And is there a website that you have maybe with some more information that anyone could view?
Yeah, I continue to struggle. It's not the most robust, but AdvantageWealthSolutions.com.
Awesome. Thanks for sharing that. So, like I said, if this is of interest, reach out to Kyle and his team to get situated with that, get consulted on an individual level. Real estate is individual. Everyone's circumstance is different. Like we were talking about, financing can make a big difference. The type of property, the down payment, the financing, all these other, there's all these moving wheels through the real estate process. It's not a one solution fits all, but hopefully we gave you some information here that's getting you excited about why real estate is so attractive as an investment. We appreciate everyone listening, taking the time out of your day to join us here today, and we'll talk to you soon. Take care.